You find a clear support level on the chart, wait for a pullback, and hit buy. To manage your risk, you place a logical stop loss just a few ticks below that support line. Minutes later, the price dips just far enough to trigger your stop and liquidate your position. The moment you are out of the trade, the asset reverses and rockets in the direction you originally predicted. While it feels like bad luck, this sequence is often a targeted hunt. It happens within the lit market, the public exchanges where every bid and offer is visible to the world. Massive institutions generally avoid these public exchanges. Instead, they execute their largest trades in dark pools, private matching engines that allow hedge funds to move millions of shares without the public seeing their intent. This creates a data gap called order flow. Many retail brokers sell your live trade data to institutional high-frequency firms, giving them a real-time map of where every retail buy and sell order is sitting. Algorithms use this purchase data to locate clusters of retail stop losses. By momentarily pushing the price into those levels, the algorithms hunt your stops to generate the liquidity they need to fill their own massive orders. Within this structure, retail trades act as a predictable resource. Your entries and exits provide the necessary volume for institutional machines to position themselves more effectively. When an institution needs to buy 5 million shares of Apple, doing it on a public exchange creates an immediate price spike. They'd end up paying a much higher price for their last million shares than their first. Dark pools solve this by masking the size of the trade. The public doesn't see the volume or the price action until after the institutional position is already locked in. Even in the dark, these algorithms require someone on the other side of the trade. To buy 5 million shares, they need 5 million shares worth of sellers to match their hidden orders. Institutions specifically seek out uninformed retail order flow because retail traders often rely on lagging indicators and emotional reactions. They are considered the safest counterparty for an algorithm to trade against. This means the financial system is structurally incentivized to route retail orders directly toward these institutional algorithms, where your trades are used to facilitate their massive volume. To see through this, you have to move beyond standard charts. Forensic tools like Bookmap or the Delta footprint allow you to see the actual transactional war zone happening in real time. A standard candlestick is essentially a hollow box. The footprint chart splits that box open to show the delta, the difference between aggressive buying and selling at every single price point. Look at this specific anomaly. At the very bottom of this move, we see a massive cluster of negative red numbers. This shows intense, aggressive panic selling from retail traders. But notice the contradiction. Despite the huge influx of sell orders, the price isn't dropping. It's holding perfectly rigid. This is absorption. A hidden institutional buyer is sitting here with a massive limit order, quietly swallowing every panic-sold share. Once the algorithm has exhausted the sellers and trapped them at the bottom, it removes its limit orders and allows the market to snap upward, leaving those retail sellers in a losing position. By reading the raw order flow, you can identify the exact moment where machine-driven absorption overrides human panic. Relying on delayed public charts means you react to information algorithms have already processed. When you trade based on common retail signals, you are operating in a market optimized to exploit those very patterns. The solo quant approach moves away from this. We don't try to predict where the price should go based on retail sentiment or standard technical setups. Instead, we monitor the delta footprint for the invisible tracks of institutional movement. We look for the footprint of absorption, the sign a major player is building a position. When the data confirms that the retail trap is sprung, we execute our trades alongside the algorithm, utilizing their momentum to power our entries. You can't outrun the ghost machines in the dark pools, but by learning to read their code, you can stop being their fuel and start riding their wake.